Hello, in this lecture, we will define treasury stock. According to Fundamental Accounting Principles, Wild 22nd edition, the definition of treasury stock is corporation's own stock that it reacquired and still holds. So treasury stock is going to be a form of stock holdings for the corporation, difference being that it's a reacquiring of its own stock. So for example, if we had Apple Corporation and they issued their stock out there, we have Apple stock on the market, then Apple decided, the corporation, to reacquire for market prices their own stock on the free market, then those stocks that they would then hold would be the treasury stock. As opposed to if Apple was to acquire some other type of company. If Apple acquired an unrelated company like McDonald's, then they can acquire that stock. It would be on the books as an asset and investment in McDonald's. If we take a look at an example, we see our trial balance over here, and we can see that this light blue section is going to be our equity section. We have our common stocks, we've got our paid in capital, the amount we paid in excess of the common stocks when it was issued. We have the treasury stocks, that we don't have any yet, and the paid in capital on the treasury stocks and retained earnings. The total of these are the equity section. So it's similar to any type of entity in that equity as a whole is basically the book value of the company or what is owed to the owner. A corporation having a bit more complex equity section because we need to break out basically the common stocks, the investment portion, and the retained earnings, the accumulation of revenues. If we were to say purchase our own treasury stock at 5,000 units of treasury stock that's already on the market, our own stocks, at a market price, we're saying $25, then 5,000 times the 25 is 125,000 that we would purchase back of our own stock. The journal entry is pretty straightforward. We would just debit or credit cash for the amount of cash that we paid, reducing the amount of cash. We would then debit the treasury stock, and that would debit the treasury stock in this format. This seems pretty straightforward. That's what we would think we would do if we purchased any type of stock. If we purchased McDonald's, we would credit the cash we paid and we would debit the stock. However, in this case, we're debiting the treasury stock, which is in the equity section, as opposed to if we purchased stock in another type of entity that we were not related to, such as if Apple was to acquire stock in, say, McDonald's, then that would just be a form of investment and the debit would be in the asset section. And in this case, we're purchasing our own stock. It's going to be part of the equity section. The other thing that's a bit strange is that we have the debit balance in the equity section, and we can see that by the positive number over here, whereas most of the equity section is credit balances. So it's kind of like a contra equity account, meaning it's reducing the equity section. If we were then to have dividends that were going to be declared and paid, if we had a $2 dividend that we were going to issue, then we would have to take the common stocks that were out there and reduce the treasury stocks in order to then calculate the dividend. So the dividend then would be the 90,000 in this case, point being that we had 50,000 common stock shares. We're removing the treasury stock, meaning we're not going to pay the dividend to ourselves. So if we were to record the dividend, then the dividend being something that's going to reduce retained earnings with the debit, and then we would have the dividend payable at this point. And the main point being here that we're not putting the dividend or calculating the dividend or distributing the dividend to ourselves.